Just waiting for him. I've been doing mortgages since 2003. Year after year, I still get asked the same question. Where do I start? What's the first step to owning a home? Let me ask you a question really quick. If you are buying a home and you plan on financing the home, that means you're going to need a mortgage, which means you're going to have a mortgage payment. So the first step to buying a home is understanding your mortgage budget. There's two parts to your mortgage budget. Part number one, identifying what is your mortgage budget. And number two, how to manage your mortgage budget. So tonight we're going to go over the secrets to budgeting a mortgage payment. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. And tonight we're going to take you through the first steps of being a homeowner. Let's start, guys. So, guys, with the first step of being a homeowner, of course, is determining who's going to be on the loan. I see people run into this problem all the time. Oh, wait, I forget. If it's your first time tuning in to our channel, do me a huge favor. Hit the subscribe and notification button so you're notified every time we go live or post new content. We go live Monday nights at 9 p.m. and we post content on YouTube Wednesdays and Fridays, and we post content daily on Instagram and TikTok. Also, guys, it's an interactive channel, so ask a lot of questions. Okay, let's get back into it. So the first step with owning a home is who's going to help you with your mortgage payment. I see this happen all the time. A consumer calls a lender and tells them, hey, I want to buy a home. This is the payment I can afford. But sometimes they forget to tell the loan officer who's going to help them with the mortgage payment, right? Sometimes the people who are going to help with the mortgage payment are not going to be on the loan. So if you have someone who's going to help you with a mortgage payment and they're not going to be on the loan, you can't include them in your mortgage budget. Even though they're helping you with the payment, since they're not going to be on the loan, they can't help you qualify. So you can't budget their income to help you qualify. It happens all the time. So if they're not going to be on the loan, you can't include their income. If they're going to be on the loan, they must have a social security number. They must be a permanent resident, a U.S. citizen, or DACA, or they're here on a visa. Also, they must fit the credit qualifications. If they don't fit the credit qualifications, they can't go on the mortgage. Also, if you're going to buy a home using a government loan, FHA, VA, USDA, you got to run the spouse's credit. Sometimes the spouse can't go on the loan because they don't fit the credit requirements, but you got to include the debt. And it happens a lot on government loans where I can afford such and such mortgage payment, but you can't include your spouse's income. So you can't include it. You can't use that income to budget your mortgage payment. And that's the first step. So before you fall in love with the house, before you tell your friends and family about your home ownership plans, make sure you know who's going to be on the loan. Whoever's going to be on the loan is you can use their income to help you with the budget. If you can't use their income, don't include them in the budget. You're just setting yourself up for failure, okay? That's when sometimes you might have to add a cosigner, which we'll go over in a second, all right? So step one, identify who can help you with the budget. Whose income can you include? Step number two, understand what debts are included in your budget. So it's more than just your mortgage payment. There's other debts as well. Understand that there's two parts to your debt. There's the front-end debt, and then there's the back-end debt. They call that your debt-to-income ratio. There's a front-end debt-to-income ratio, and there's a back-end debt-to-income ratio. And with these formulas, the banks have made it clear if you stay under the debt-to-income ratio, your chances of foreclosure is low. If your debt-to-income ratio is too high, your chances of foreclosure is higher. So they have set a plateau of where your debts can go. Okay, so what's included in your debt-to-income ratio? There's the front end, which is your primary debt, okay? So when we talk about debt-to-income ratio, there is a front-end debt-to-income ratio. That's your primary household debt. That is where you live. So if you are buying a house to live in it, that is your mortgage payment. If you are buying your first home as a second home or an investment home, that's the place where you rent. If you live somewhere rent-free, then your front-end debt-to-income ratio will be 0, okay? So when you're calculating your budget, your debt to income ratio, just know there's a front end and the back end. And the front end is your household debt. Okay. If you buy a home and you're going to take your current rent and not include it, right? That's the only time you don't include your rent if you are buying an owner-occupied home. But if you're renting somewhere or living rent-free and your first home is an investment or second home, then you will include the rent into your front-end debt. If you're including mortgage debt, right, in your primary mortgage debt, there is your principal and interest payment, there is your property taxes, there is your hazard insurance, there is your PMI if your loan has PMI, and there's HOA if your loan has HOA, right? If the property has an HOA. So that right there is included in your front end debt to income ratio. Don't include your utility bills, don't include your cell phone. This is just your household debt, okay? Your primary household debt. Now let's talk about the back end debt to income ratio, right? So the back end debt to income ratio includes the front end, right? The back end is your complete debt to income ratio. So it includes your front end, your household debt, your primary household debt, also includes your credit debt, which means any debt that shows up on your credit report. So when the lender runs a credit, whatever monthly payment is on your credit report is included in your budget, included in your debt to income ratio. Also court order debt, alimony, child support. If you owe money because of a lawsuit, you have to make monthly payments. Those are included in your debt to income ratio. It's in your budget because you're required to pay it every month. Okay. The third type of debt that's included in your debt to income ratio or your budget is your government ordered debt, IRS payments. Yes, if you owe the IRS money, you can still buy a home. You just have to include the payment in your debt to income ratio. Also, like I said, if you're buying a home and it's your investment home or a second home, that mortgage payment is included in your back end debt to income ratio. You don't include it in your front end. Your front end is your primary household debt. So it's either the mortgage that you're buying, if you're buying a primary residence, right, the mortgage that you're getting, or your rent. If you're living at home rent free, then of course it would be zero for your front end. But if you're buying an investment or second home, then that would include your complete debt to income ratio. Okay, so now, which just popped up. Now that we know who's going to help you with your budget, we also know what's included in your budget. The next step is identifying how to calculate that budget. Okay, so it all depends on the program you're going to go for. Okay, when you talk to a lender, if you have good credit, most likely you're going to go with a conventional loan or a jumbo loan if the loan amount is above the county loan limit, or you're going to go with a government loan, FHA, VA, USDA. Every program has set their own guidelines for the budget, the debt to income ratio, right? There's a front end and there's a back end. And how do we calculate it? You take the monthly gross income of everyone who's going to be on the loan, right? Step one. That's why you need to identify who's going to be on the loan first. Okay, I see people do this all the time. They count their mom, who's going to help them with the mortgage payment, who lives with them, but for some reason she can't be on the loan. You can't include her income to help you calculate your debt to income ratio. Only the people who are going to be on the loan. Okay, so you take the monthly gross income and you times it by 45% for the front end and 50% on the back end for a conventional loan. On a government loan, it's 45 over 55. On a jumbo loan, it's 43 over 43. Okay, so that's how you calculate it. For example, you can take $10,000. If you gross $10,000 a month, you would times it by 45%. So the front max of your front end debt, your household debt, your max mortgage payment can be $4,500. And then you would take that $10,000, you would times it by 50%. That means your complete overall debt can be $5,000. That leaves you only $500 a month for wiggle room in the perfect scenario if you get that max mortgage payment. All right. Same thing with government loans. If you take $10,000, you're at $4,500, and your total back end would be $5,500. That means you're allotted $1,000 a month in debt. And when you go with a jumbo loan, there's not too much wiggle room, right? If you make $10,000 a month, it's $4,300 for the front end. If you do, the total debt would be $4,300. So if you had a max mortgage payment of $4,300, guess what? There's no wiggle room for debt. So that right there is how you calculate your debt to income ratio. So like I said, there's two parts to your mortgage budget. Number one, identifying what is your budget. Of course, step two is how do you manage that budget? But of course, in step one, in phase one, there's 3 steps. Step one, who's going to help you with your mortgage payment, right? Can they go on the loan? You can only include the income of the people who's going to go on the loan. Number two, what's included in your budget? Your complete household debt, right? Your cost of housing. You're either your rent, you're living at home rent free, or your primary residence. And then of course the back end is your complete debt, your complete front end. You have your credit debt, court order debt, and government order debt. And if you have any rental properties or second homes, that would be included in your complete debt to income ratio. And then we went over how to calculate your debt to income ratio. Okay, we went over, you take your monthly gross income, depending on the program, is either going to be 45% or 50%, right? Or 45 to 55 or 43 to 43. Okay, so that right there is how you calculate your mortgage budget. We put up here a debt to income ratio cheat sheet for you to be able to see what can you afford. Of course, this is the perfect scenario with minimal or no debt. Guys, if you want a copy of this, go and go to whatsamortgage.com and download our ultimate mortgage guide. In our guide, we have other cheat sheets as well, but this is our debt to income ratio cheat sheet so you can see what you qualify for. Okay, here's an example. If you made 60 grand a year, right, and you went with a conventional loan, you can afford a $2,250 as your max mortgage payment, but total debt's $2,500, right? That means your wiggle room is $2,500. This is for the perfect scenario if you want to max out your mortgage payment. Look at 100,000, right? At 100,000, your max mortgage payment could be $37.49. If you had debt, $41.66. So it doesn't leave that much wiggle room, but now you can see based on your monthly gross income, what's your max debt to income ratio, right? Front end and back end. So as you can tell, I left you 43% there, 45, 50, and 55%. So you can kind of weigh in the difference. Also, I put 40 on there because some people are conservative. They want to keep their debt to income ratio under 40%, right? The great quality of life, if you want a great quality of life and no stress, keep your debt to income ratio low. That's what they should have taught us in high school. All right. So that's the first phase of figuring out the secret of your mortgage payment, right? Your mortgage budget, right? Is identifying what's in your budget. What is your budget, right? Now that we've done that, here's the second part, right? How to manage your budget, how to qualify for more home. You know how many people I run into who qualify and they're not happy with their mortgage payment? Not with the mortgage payment, what they qualify for. The reason why they're not happy because their debt to income ratio is too high. So the name of the game is how do you manage your budget to qualify for more home? Okay, let's recap here. So how do you manage your budget, right? Like we went over already on a conventional loan, right? So if you make $10,000 a month, right? This is just for numbers. To make it easy, I did 10,000, right? Times it by 45%, your max mortgage payment can be $4,500, right? Your max debt, $5,000. That leaves you $500 a month in wiggle room. If you go with a government loan, $4,500, and your back end is $5,500. That leaves you $1,000 in wiggle room. Jumbo loan, 43 over 43, leaves you no wiggle room. That's if you go with a max mortgage payment. Of course, you know, even though you qualify for the max mortgage payment, I do not recommend, hear me out here, I do not recommend you go with the max mortgage payment. Unless for some reason someone is going to help you with the mortgage payment and they can't go on the loan, or there's some sort of income that they can't document, but even though you can afford the payment, it just doesn't look that way on paper. Okay, so this is the perfect scenario. If you maxed out your mortgage payment, leaves you a little wiggle room. But anyone who makes $10,000 a month realistically will probably have more than $500 a month in debt or $1,000, right? Here's an example of a non-perfect scenario, okay? So if you made $10,000 a month, and let's say you had $1,000 in debt, right? You would qualify for a $4,000 mortgage payment. That's why I tell you guys, take your monthly gross income and times it by 50%. Right? So we did it right here on this conventional, right? We took 10,000, we times it by 50%, which is $5,000. That means our total monthly payment debts can exceed 5,000. As you can tell here, 1,000 plus 4,000 is 5,000. So if you have $1,000 a month in debt, you can afford a $4,000 mortgage payment, right? So you will qualify for $500 less home. So let's say you have $1,500 a month in debt. That would allow you $3,500 mortgage payment. If you make if you have $2,000 a month in debt, that's a $3,000 mortgage payment. If you have $2,500, a $2,500 mortgage payment on a conventional loan. And look over here in government. If you make $10,000 times it by 55%, remember their total back end is 55. But if you have no debt, remember you'll have to times it by 45, so you know you can't exceed the max mortgage payment. Okay, so let's say you have $1,500 in debt, $4,000, $2,000 a month in debt, $3,500. As you can see, government loans are a little more flexible when it comes to debt, but that right there gives you an example of how to manage your debt, right? Manage your debt to manage your mortgage payment. The more debt you have, the less buying power you have, right? Like I said, when most people qualify to buy a home, they're not really satisfied for what they qualify for. The reason why is because they won't enjoy the home. They're like, whoa, I know I can afford such and such, but the payment doesn't say so. But now you know how to budget it, right? The secret to buying the home that you want, the secret of being a good loan officer and a good real estate agent is the seesaw game. Right? I've been doing loans since 2003. I've had over 100 loan officers work under me. I tell them the secret to being a good loan officer and the secret of life and for a borrower to be happy is a seesaw game, right? You know your debt to income ratio. Once you know what program you're going with, what the max debt to income ratio is, it's the seesaw, right? Paying down debt so you can qualify for more home. The more debt you have, the less home you can get, right? It's a seesaw game. As you balance out that seesaw, you will have more buying power, right? So there's 4 ways to bring down your debt to income ratio. There's 4 ways to balance out that seesaw, right? So when you're qualifying to buy a home, that's why I tell people, don't pay off debt yet. Don't do anything yet. Be prepared. Talk to a lender. Identify with the lender who's going to be on the loan to help you with the mortgage payment. Identify your debts. Identify your program so you can calculate the right debt to income ratio, and then use these 4 strategies to increase your buying power, right? Here's 4 ways to bring down your debt to income ratio, right? Number 1, drop your purchase price, which no one wants to do, but it's the easiest way to bring down your debt to income ratio or balance out your mortgage budget, right? Drop the purchase price. Number 2, bring in a bigger down payment. Sometimes you might have to tap into your 401k or into your retirement or break a CD, right, to bring in a bigger down payment so you qualify for more home. Number 3, pay off debt, right? The more debt you pay off, the more home you qualify for, which we went over in our example, right? And number 4, which I don't love, adding a cosigner. The only time I would add a cosigner, of course, if they're going to help you with the mortgage payment, that's the best. But if they're not going to help you with the mortgage payment, make sure there's someone who's going to help you with the mortgage payment. They just couldn't go on the loan. Because they couldn't go on the loan, they can't help you with the payment, okay? If they can't go on the loan, they can't help you qualify. But if they go on the loan and they can help you, make sure you have someone to help you, all right? Let's get into bringing down the purchase price, okay? So before you decide how much to drop the purchase price, right, you got to figure out what program you're going with. Okay, make sure you follow the debt to income ratio. Are you going with the conventional government loan or a jumbo loan, right? Now that you know, once the lender calculates your DTI, they'll tell you how high your debt to income ratio is or how high your mortgage budget is that you have to bring down to qualify. Now you know, okay, start bringing down the purchase price, right? Find out what program you're going with. Make sure the income has been validated. It's so important, right? I see so many people fall out of escrow. They've been approved and they're not approved because income has not been validated. Make sure all your income has been cleared by the underwriter or the loan officer or the processor so you know what you're working with, right? You got to know what you have so you know what you're working with. Once you identify what you're working with and they've ran your credit, they'll know what your debt to income ratio is, right? Then slowly bring down the purchase price until it fits the right guideline, right? For the right program. So you keep bringing down the purchase price, which no one loves to do, but it's the easiest way. Bring down the purchase price, right? The second way we talked about bringing in a bigger down payment, right? Remember, the number 1 thing you should do, validate your income. You always want to validate your income first. Then check what program with their DTI, right? And when you start increasing the down payment, right? It's a seesaw game. You increase the down payment, see what the DTI dropped down to, right? Keep increasing the down payment. Once you get that number, you want to look at that number. Is this number realistic? Do you already have it? Or how long will it take for you to save that down payment? Sometimes if it takes a year, 2 years, 3 years to save a down payment, the home might be out of the market already. Let's say you need to save $24,000, but you can save $1,000 a month, right? So in 2 years, you'll be able to save the money. But what will the home price of the home be in 2 years, right? Are you saving fast enough to beat appreciation and inflation? If not, you might need to change your strategy. You might not be able to do the second way, right? You might not be able to save a bigger down payment. Another thing you can do is you might want to talk to a lender. If you're doing less than 20% down, you might want to buy out the PMI. You might not be able to save 20% down, so you don't have PMI, but maybe you go 5% down and you use 2% to buy out the PMI, or you go 10% down and you pay 1% to buy out the PMI instead of going 20% down to get rid of PMI. There's other strategies of bringing down your DTI, right? Instead of bringing in a bigger down payment, maybe use some of your down payment, buy out the PMI, see if it'll drop your payment. Okay, so that right there is a second step to lowering your DTI, which helps you with your mortgage budget. Now, the third way to help you with your mortgage budget is paying off debt. Okay, that I feel is the most efficient way to allow you to qualify for more home. Okay, paying off debt first. If you have debt, how much debt do you have? Right? When you talk to a lender and they run your credit, you have the credit report, you want to look at all your debts. Sometimes you might have a debt that's a car payment, or a car that has a couple $1,000 on it, but it's a $300-$400 payment. That can affect your debt to income ratio. Okay. So when I tell people paying off debt, look at your debts first. Is it easier? So I did this number with $50,000, right? So typically most people will qualify $50,000 less. The home they want is typically the payment that they qualify for is typically $50,000 less to the home they actually are in love with. So I did $50,000. Some of you guys are $100,000, right? So is it easier to drop the purchase price $50,000? Some people don't want to do that. Is it easier to bring in $50,000? That is even a harder thing to do, right? So right now, if rates are at 3%, we did this on an FHA loan. Right, of course, rates can change. This is just numbers here. I crunched the numbers on a $50,000 home. I know there's homes out there not for $50,000, but I did worst case scenario on a $50,000 home with PMI and FHA loan. If rates were at 3%, the monthly payment is $340. That means for every $340 a month, that's $50,000 more home. You might be able to look at your credit cards like, hey, I might be able to eliminate a $10,000 credit card instead of bringing in $50,000 or coming off the purchase price $50,000, right? So if the rates are at 4%, it's $370. If rates are at 5%, $400. If rates are at 6%, $430, which means you would have to pay off that much in monthly debt to qualify for $50,000 more home. Okay, so that is the third way to help you with your mortgage budget, right? Number one, we talked about bringing down the purchase price. Number two, we talked about, right, bringing in a bigger down payment, which could be a lot harder because depending on how long you need to save or unless you already have the money. Number three, paying off debt, which I love the most, probably is the most efficient way to do it. And the last but not least, which is not my favorite, but I still got to talk about it, adding a cosigner, right? Adding a cosigner. What did Spider-Man say in the movie Spider-Man? With much power comes much responsibility, okay? So if you add a cosigner, that's a lot of responsibility. Because if you miss a payment, it affects their credit. If you add a cosigner or co-borrower, right, and they're not going to be helping you with the mortgage payment, even though you're using their income to qualify, if they're not helping with the payment, what's the use of that? Unless there's someone who's going to be living there helping you with the payment and they can't go on the loan. Unless you're self-employed, you got some funky income, and the lender cannot use it for some reason, then I think a cosigner is okay. But if you don't have help and you can't qualify straight up and you add a cosigner just to qualify, I think it will hurt your chances, right? Carefully choose the right cosigner. Everyone has an Uncle Rico, right? He has cars, has a nice home, has a boat, but no one realized when you lift up Uncle Rico's hood, he might not be the best person to help you qualify. He might actually hurt your qualification because he has so much debt, right? Because they have a lot of credit doesn't mean they're the right cosigner. Here are signs of a great cosigner. So before you get your Uncle Rico involved or start running everyone's credit, here's signs of a good cosigner. Sign number one, that cosigner better have better credit than you. If their credit is not as good as yours, unless you need them that badly, their lower score can hurt your credit profile, which means you can qualify for less home because you have a higher interest rate or it's a payment you're not in love with. So the perfect cosigner would typically have the same credit as you or better. Number two, a solid job, right? Make sure they have consistency with work, even though they have really good credit, right? If they're not consistent at their work, you can't use the income to help you qualify. Make sure they've been at that job or the same line of work for 2 to 5 years. If they're self-employed, make sure they actually showed income on their tax returns, which a lot of self-employed people, right, who always want to help their uncle or their cousin or whoever qualify, writes off everything. The third sign, minimal debt. Like I said, sometimes Uncle Rico might not be your best choice. The reason why? He got too much debt, right? You want to make sure he has minimal to no debt, because every debt he has is counting against your debt to income ratio, right? Your complete back end debt, as we talked about earlier. So make sure there's minimal debt. If there's not minimal debt, there better be insane amount of income. And last but not least, right, the perfect cosigner is not paying rent or doesn't have a huge mortgage, right? Remember, if they have rent or a mortgage, it counts against your debt to income ratio. Okay, so when you're out there looking for cosigners because you don't qualify and someone else is going to help you with the payment, you just need a cosigner. If someone has rent, that rent is counting against your debt to income ratio, right? If they live rent free, then that's okay, right? That doesn't hurt you. But if they have a mortgage, that is also counting against your debt to income ratio. Imagine if they have investment properties as well. That can really hurt your chances of getting a home. I see so many people scramble for cosigners, right? Because the lender didn't validate the income. Right? So the debt to income ratio was off. And now they don't want to drop the purchase price. They can't bring in a bigger down payment. They can't pay off debt. And they got this boo-boo cosigner that pretty much is hurting them compared to helping them. And I see it happen a lot. So be very careful with the cosigner. So those are the 4 signs of a great cosigner. And remember, when you add a cosigner, remember the math, right? I typically do whatever the debt is, times it by 2, right? I'll do the 50% debt to income ratio. So for $50,000 more home, if rates are at 3%, right? Like we said earlier, when rates are at 3% on a $50,000 home, the monthly mortgage payment is $340. So it's 50%. That means you have to times it by 2, right? So someone has to make double the amount of money to qualify for that payment. For example, if the mortgage payment, or if you have $1,000 a month in debt, you can't make $1,000 because you can't live. If someone has $1,000 a month in debt, they would need to make $2,000 a month in income to qualify to pay that debt. So for $50,000 more home, if rates are at 3%, your cosigner needs to make at least $680 a month without debt. When rates are at 4%, they need to make $740 a month. Of course, if they have debt, you have to add, they need to make more money, right? If they're at 5%, they got to make $800 a month. At 6%, they got to make $860 a month to qualify for $50,000 more home. Okay, so hopefully that helps you right there decide if you're going to add a cosigner and what type of cosigner to look for. The last thing you want to do is scramble in escrow looking for that cosigner, right? And all of a sudden, you don't qualify. And that right there, my friends, is the secret to budgeting your mortgage payment. So turn off the notifications on Zillow. Don't tell any more friends or family what your plan is to become a homeowner. Figure out your budget first, right? There's 2 phases. Phase number 1, identifying your budget. Who's going to be on the loan? What debts to include in the loan? What program you're going with so you can calculate your debt to income ratio. And the second phase of your mortgage budget is managing your budget, right? How much income do you have? How much debt do you have? Do you need to bring down the purchase price, pay down debt, right? Bring in a bigger down payment, or add a cosigner? Once you decide all that, then you can move to the next step of credit, right? That's why it's important. People ask me all the time, like I said, what's the first step to home ownership? And the first step is mortgage budget, right? And that's the secret to figuring out your mortgage budget. Hopefully, guys, this video brought you a lot of value. Do me a huge favor. Save this video, share this video, and like this video. And if you're not following us on Facebook or YouTube, please hit the subscribe or notification button, right? Let's go into some Q&A here really quick. How'd I do, Andy?
Did great. Did great.
What's up, Keys? Super excited about the live. Thank you so much, Keys. Gus, lifelong subscriber here. Thank you so much. Annabelle, thank you. DL, can a brokerage account be verified and used as proof of funds? The answer is yes, DL. Jolene, what's going on? Hi, Dad. Jabo. Speaking Vietnamese to my dad. Truly the best information online. Thank you, Gary. Jolene, so you explained it so clearly. Thank you so much, Jolene. Keys, was good, fam. Maria, was good. Keys, qualify for more home is great. Keys, what does debt consist of? Credit cards, school loans. Does it include regular bills and cell phone? So keys, what's included in your debt? Yes, it's your debt when you the debt on your credit, government debts, court order debts, right? Child support, alimony, if you're being sued for something, you owe monthly payments, but do not include your cell phone bill or any utilities or any personal insurance. Health insurance, life insurance, don't include that. Car insurance, but you are going to include hazard insurance for the home and PMI insurance, okay? Remember, no personal, but home insurance, yes. Hopefully that helps you out there, Keys. Francisco was good. Could you kindly talk about buying the PMI process? So Dale, when you buy a home with a conventional loan, there's three types of PMI. There's lender paid MI, which means you will take a higher interest rate and it's built in the rate and the lender will pay your PMI for you. Second way is your monthly PMI, which that's pretty traditional, where every month you have PMI until you have enough equity and the PMI will come off. And the third way, you can pay all your PMI at one time. It's called single premium private mortgage insurance. Typically, I wouldn't recommend it unless you have above a 740 credit score. But if you put 5% down, sometimes it costs you 2% to buy out the PMI. So your total out of pocket is 5% for the down payment, 2% to buy out PMI, and 3% for closing costs, right? That right there will drop your debt to income ratio because you won't have PMI, right? If you're putting 10% down, typically the buyout of the PMI is 1%. So instead of putting 20% down and not having PMI, you can go 5% down and use 2% to buy out the PMI, or go 10% down and use 1% to buy out the PMI. That can save you, right, 15 to 10% down, right? You can buy it out. Hopefully that helps you out there, Dale. I have $20,000 in debt and my credit is 705. I make $7,500 a month. I live in Santa Clarita and the house is 550 and up. How much would I be able to qualify for? Andy, can we bust out the techie or no?
Just go ahead and pull up the web browser and I'll put it on screen when you get it.
All right. I'll bust this out for you really quick here. Let me see. What is it? Where's it at?
Grab wherever. Just put it
All right.
somewhere.
All right, cool. Let me go up here.
No, bring it low. You look funny.
Okay. Okay, bring it. I know I'm bringing it down right here. So, all right. This is for Edwin, okay? Edwin, because you watch our show, I will do this for you. Right? So, see, the thing is, if you have $20,000 in debt, what is the monthly payment on that $20,000, right? I would need to know the monthly debt, actually. Actually, I can't do it because I need to know the monthly payment on the $20,000. So if you give me the monthly payment on the $20,000, I will do that for you, right? So give me the monthly payments on your 20 grand, Edwin. I'll bust it out for you. Mary Jane, is changing employers will that affect my mortgage loan application currently waiting on underwriting decision? If you change employers, Mary, and you're in the same line of work or the same industry or same position, and it's a salary or hourly, you're fine. If the lender used overtime or bonus to qualify you with your old job and your new job doesn't have it, then of course you can't use it. But if your new job has it, but your old job doesn't, you can't use it. Hopefully that helps you out. You're the best. I understand more. Thank you so much, Jolene. Eric, what's going on? Dale Talon, what's going on? Hey, man, what is the difference of high balance and jumbo? So, Jan, depending on the county, for example, Orange County, right? Orange County has a loan limit of 500 something, right? But if you go above that 500 something, there's a high balance loan limit of 800 something. But once you go past that 800 something, it's jumbo. If you go Riverside County, anything I think 500 something, it's jumbo. So it all depends on your county what the conforming loan limit is. When you pass the conforming loan limit, that is jumbo. Okay? Hopefully that helps you out. All right, let me jump in here and do Edwin's scenario. So Edwin makes $7,500 a month. Okay, let me get into that. You want to jump onto it?
Take the months.
Okay.
Oh, you want me to?
Yeah.
Let me switch over.
All right, let me switch over really quick here. So give me 1 second here, guys. Help out Edwin. If someone else has a scenario, I would need to know your monthly gross income, your monthly debts, okay? I would need to know your monthly debts. And then after that, all right. And how much you have for your down payment. If he doesn't give me one, I'm just going to come up with one for $550, okay? So we go here. We have this qualifier on here. Guys, definitely check out this qualifier, right? So let's go. We're at a 50% DTI. Monthly income, $7,500. Monthly debts, $750. Right?
Quick, let me change something.
Give me 1 second here, guys. Andy's changing something.
Can you make it go to the top right corner?
Yeah, hold on.
Top right. Top right.
It won't do that whole corner thing.
Just do it this way.
1 second here. This is for Edwin here, guys. So be patient. If you do have a scenario, I would need your monthly gross income. I would need your monthly credit debt. And I would need to know the purchase price. Okay.
Go for it.
So he has 7,500. Sorry. So we have here a little calculator that will tell you what he qualifies for. So if we go with a 705, I would go FHA, by the way, right? Because your payment would be too high on 550, right? Let me see here. 550. FHA. Okay. 3.5% down. What's the purchase price here? Oh. Okay, so at 550, 3.5% down. The mortgage payment is going to be 32.18, right? Which makes your debt to income ratio over by $200. So if you made $7,500 a month, your debt to income ratio here is 42, which you qualify on the front end, over 52, which is the back end. But remember, with FHA, even though you don't qualify, I forgot, FHA allows you to go to 55%. Okay? So you would qualify, but you would qualify 42 over 52, Edwin. All right? Hopefully that helps you out. If you go with an FHA, you will qualify. I just don't like the fact that your back end's too high. Okay? Hopefully that helps you out. See here, go back. Next, Jolene, thank you so much. Hopefully that helps you out there. Hi, Minh. See here, 750. All right, I got the mouse here. I'm going down. Let me see, 750. Mary Jane currently sign a contract to purchase for new construction for 525. FHA 3.5% down. First time builder gives you 8,000. Yeah, I think that's a what's the rate? Yeah, that's a pretty good. That's a pretty good deal. That's a pretty good deal right now, Mary Jane. I don't know when you can lock, but that's a good deal. Gretchen, what's going on? Been trying to buy since January. Be patient, Manatu. Be patient. Gretchen, monthly debt 0, 650 monthly, 650 credit. Let's see. No debt, 650 credit score, income 6,400. 10 to 15% down. Okay, this is the last one here for the night, Gretchen. I'll do this one for you really quick here. So you have a 650 FICO score. I would go FHA for sure. Okay. Go up here. Monthly gross income. I'll go to the credit. Okay, let's go here. 6,400. Yeah, ready?
I'll take it.
All right, 6,400. You guys can do this calculator yourselves too, as well, by the way. So 6,400. 6,400. No debts. Oh man, I can't. Let me see here. 6,400. FICO score, I would still go. Oh, you want to go conventional? Let's see, 6,400. No debts. 10 to 15. Let's go 15% down. I'll go conventional since you're going 10, 15% down. 650 credit score. Gretchen, with that, if I were you, I'd work on getting that credit score up to at least 680 to get a respectable deal. All right, hopefully that helps you out there. It's 527. 527 right there. Rate's probably going to be like 3.5 because of the credit. 15-year, 15% down. All right, I got to calculate your PMI. PMI here with a 650 credit score. 15% down, 650. 650 score. 0.91. 0.91 here. 0.91, 0.88, 0.8, 0.91, 91, 0.78, 0.78. Okay. your monthly payment, $29.17. Let's bring this down to $50. With the conventional loan. And you will qualify. You have an extra $282 for. You have an extra $282. Your front end is 45 over 45. Hopefully that helps you out there. All right, guys. If you do have more scenario, do me a favor. Give us a call or reach out to us 714-790-9697, or you can email us at info@whatsamortgage.com. All right. Hopefully that helps you out. Edwin, please reach out to us. Same thing with Quinton. Please reach out to us for us to help you. Let's see here. Better credit, better deal. That is right. Correct. Gus, if my work contract is 10 months, 10 months year pay, 10-month payment, so I use monthly payment or yearly. You would take the 10 months divided by 12 because it's over 12 months, even though you're getting paid for 10. Hopefully that helps you out there. See, I guess you're a teacher, right? So typically what I do is I take the monthly gross income and the yearly gross income. I divide that by 12, not by 10. Hopefully that helps you out. All right, guys, hopefully that helps you out. Do me a favor. If you're not subscribing to our channel, please hit the subscribe or notification button so you're notified every time we go live or post new content. All right, guys, hopefully you enjoyed tonight's live. If I brought you value, do me a favor, save this video, share this video, and like this video. All right, guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you so much, guys.